is the Minsky moment. Hyman Minsky is a famous economist who analyzed business cycles. And a Minsky moment historically is when you have a business cycle that gets overextended and you have a major collapse in asset prices when the credit crunch happens. It shows that basically credit expansion and stock prices and asset speculation moves at a steeper parabolic curve than the GDP does. So like when GDP goes up like 5%, the speculative assets will go up 15 to 20. But then when GDP goes down 2 or 3%, then those go down 40 or 50%, and it's shaped like a parabola but with a much stronger down slope during the down part of the Minsky of the financial crisis. Actually, the financial crisis is a good example of a Minsky moment. So honestly, Hyman Minsky did not coin the term. It was coined by PIMCO economist Paul McCulley in 1998 to describe the Russian financial crisis and how things were going fine really until the Russian ruble broke, and then the whole Russian financial markets and economy just completely collapsed in one Minsky moment. And why Minsky moments happen is also a lot due to leverage, because when speculative investors buy things, they often, whether it's real estate or stocks, they often buy it with margin or mortgages in the case of properties. And so if you're levered, you can't stay in the position the whole way up or down. If it moves a certain more than down than a certain amount, if it's a stock position, you're going to get margin called, and your payments on your mortgage are due no matter how well the economy is good or bad. And a lot of places have incentives structured in that, like if you're underwater on your mortgage, you can walk away with little penalty, and that's kind of what happens. So people see that they're in negative equity, unlikely to recover. They walk away from the property, and then once they're done with that, the bank now has to force to sell it so at least they can recover the most they can on their loan, and that causes a spiral of selling. And then with stocks, it's margin calls. And futures, it's also margin calls. So you have the worst liquidity contract right when everybody needs to sell, which then accelerates the sell-off further. And so, yeah, Minsky moment is really just the mechanics of a bust. And it actually kind of Minsky moments and Minsky's philosophy on this actually highly correlates. It's very similar to the Austrian business cycle. And with that, we are going to wrap up layer 6. We've got one more before we get to my own additions to the iceberg. Thanks for watching.